Hello everyone, and welcome to this Association of Corporate Treasurers webinar on money market funds in conjunction with Aviva Investors. I'm James Winterton, an Associate Director for Policy and Technical at the ACT. The primary objectives of a money market fund are typically the preservation of capital and the provision of liquidity, with yield being a secondary objective. But as the COVID-19 crisis became pandemic in March 2020, central banks launched a series of interventions in response to the unprecedented volatility and liquidity pressures seen across financial markets. So, over the next 45 minutes, we will be discussing the current rate environment and the implications of monetary policy on money market fund yields. Against this backdrop, a report in July by the Institutional Money Market Funds Association highlighted that assets under management by its members had recovered to record levels. And first, for anyone unfamiliar with the terminology, I'll just explain some of the acronyms in case you're not familiar with them. LV-NAV, that's low volatility net asset value. PDC-NAV, that's public debt constant net asset value. And VNAV, variable net asset value. But before I introduce our panel from Aviva, a little bit of housekeeping. You'll see a Q&A button on your screen that allows you to submit questions to the panel. We won't mention your name, and we'll try to tackle the questions as we go along, but please don't wait until the end to send them in. We'll also be conducting a couple of audience polls during the webinar, so please do take part when invited. And this session is being recorded, and the slides should be available on the ACT website by the end of this week. Our first speaker from Aviva Investors will be Tony Colcott, Global Head of Liquidity for Client Solutions. Among his other responsibilities, Tony manages the Aviva Investors Pan-European liquidity business. Tony will set the scene by reminding us of money market regulatory reforms, the dash for cash triggered by the COVID-19 crisis, and the impact of monetary policy responses. Next, Caroline Hedges will elaborate on the current rate environment and the implications of negative yielding debt for investors in money market funds. Caroline is the Global Head of Liquidity Portfolio Management at Aviva Investors, overseeing the portfolio management of liquidity funds in the UK and Europe. She also manages the Sterling Liquidity Fund. Finally, Mohamed Al-Fayda will share some insights on maintaining liquidity and security, as well as opportunities for enabling optimized performance. And Mohamed is portfolio manager on the global liquidity team at Aviva, focusing on managing Euro money market and short duration bond funds. So I'll now hand over to Tony.
Good afternoon, everyone. Let me start by thanking you all for making the time to register and listen into our discussions around lower yielding environments and the consequences of this changing dynamic on the management of money market funds. We'll be drilling down the types of options that are available to treasurers to help with the management of their cash pools. And a question that's often asked continuously, and one that we ask ourselves at Aviva, is, are money market funds still a viable alternative to bank deposits? We feel that certainly are, and as a product they've shown, especially through times of crisis, to be resilient and a valid vehicle in order for investors to gain the diversification, access to liquidity, and security of capital that they require. The need for money market funds has been one that's been needed by all types of clients, be it large corporates, be it financial institutions, pension schemes, local authorities, county councils, charities, housing associations, and all have had the same common goal, namely security of capital, diversification of investments, and access to cash on a same-day settlement basis. I think it would be prudent at this stage to wind back a little to the implementation of the new regulations that our industry embraced during 2018-19. The impact of these changes meant that money market fund providers created money market funds to be even more fit for purpose than ever before. Navigating through times of crisis and stress markets has been so much easier for us all to manage as a result of these regulatory changes. So it is with confidence that we can say that money market funds are still a viable alternative to bank deposits, resilient in times of stress market conditions, and will continue to be so looking forward. Before I progress further, James, I think I'm going to hand over to you for a question.
Sure, Tony. So our first audience poll that we have is, where does your corporate treasury currently prefer to deposit its short-term surplus liquidity? Please choose only one answer representing your highest usage by value. So please, if you can select one answer and then press submit. And just while we give everyone just 20 seconds or so to do that, Tony, do you want to just briefly say a bit about how the COVID-19 crisis has impacted your ability to service your clients?
Yeah, I mean, look, it's been a really challenging time for everyone. I mean, we've all had to adapt to new ways of doing business virtually. We've had to work really hard to ensure that our day-to-day practices remained really robust and efficient. However, despite all the challenges, commercially and personally, it's been difficult to deal with this for all of us through this crisis. Productivity, we feel and have seen, really rose. I mean, throughout. I mean, people were way more productive in the earlier stages, and maintaining that is a difficulty now, of course. But still, productivity seemed to go up exponentially. So I think from that, it's fair to say that it's not just money market funds that are resilient through a pandemic. We've also proven to be that as well. I think during the time, we had to move really quickly, and we had to adapt really quickly to be able to work from home. I mean, technically, facilitating so many workers internally was quite a challenge, but certainly we're up for the task. I think initially as well, there was a lot more collaboration between colleagues and workers. There were a lot more phone calls. And what we felt with the clients, and certainly the feedback we got, was that they didn't want to be pestered. I mean, everyone was facing their own challenges through this time. And certainly what they didn't want was a fund manager pestering them for their time. So we endeavoured to be a bit standoffish, really. We took a step back. We gave them space. But while doing that, we ensured that we created the right information. We disseminated it in the right way. It was a focused approach to get that information out and disseminate that content. So I think from that point of view, we showed ourselves to be very supportive and basically be there for our clients. And that's what they needed from us, to ensure that we were, in fact, there for them.
Yeah, thanks, Tony. And I'll move on to the poll results now, because it's quite interesting. For those who perhaps dialed in sound-only mode, the results of the first poll, where we asked where currently a corporate treasurer is preferring to deposit by value their surplus liquidity, is we have bank deposits on nearly 48%, money market funds on nearly 41%, and then trailing really quite a long way behind, we have segregated or direct holdings of T-bills or short-dated bonds at 5%, other at nearly 4%, and tri-party repo at 2.5%. So, Tony, briefly, is that the sort of spread you were expecting to see?
Yeah, I think so. I mean, we've seen over the last months that generally there's been a dash for cash. Certainly since the pandemic outbreak. I mean, I think you alluded it to yourself that that the AUM through our industry has recovered, has risen. And I think, ultimately, it still is the security of capital, the diversification, access to liquidity that people crave. That's what people need. They need that security to know that their money is safe. So we certainly saw a rise in assets from our point of view. There was a stockpiling of cash, I'd say. There were fewer wants to be out there for mergers and acquisitions. It was very much, let's ring fence our cash, let's see how things settle. So as a consequence, certainly more money coming through to the cash markets. And I think in the short to medium term, it's our opinion that, based on discussions that we've had internally, but also with our clients, that want for security of capital, that need for a diversity of counterparty exposure, the need for daily access to liquidity is going to continue to be of the highest importance. So the challenges that we now face, aside from ensuring that we can embrace the new way of working, is adapting to the potential changes in the rate landscape, both here and potentially in the US. Now, interest rates have been low for many, many years in some geographies, and in some cases negative. The question to ask is whether we'll see this pattern repeated in the UK and in the US. And if we were to, how do we manage through that, and how do we ensure that our business remains fit for purpose? In the last few months, we've seen coordinated action from central banks and governments around the world to limit the long-term impacts from this pandemic. Monetary easing has been significant. The possibility now of deflation, sustained recession, rising unemployment, they're all real concerns, and discussions around how we combat this are ongoing. Will the Bank of England follow the ECB, Denmark, Japan? Will they take rates negative? As a provider of cash solutions, we all need to be quick to react to change. We need to be innovative, nimble, confident, and assured in our investment decisions. Not just in times of crisis, by the way, but always, all times. But it's paramount that we plan. that we are able to facilitate a change in fund structure should market dynamics and scenarios dictate, to maintain business as usual, and to ensure that the clients, our clients, all clients, have the confidence to invest in our products going forward. So I think going ahead now, we'll talk about some scenarios, what-if scenarios, opinions on the rate environments, and how our product set will or would react to the potential of negative rates, and moreover, lead into the outlining types of alternative solutions that could be available to investors that might consider taking a more flexible approach to cash management through products such as enhanced funds or indeed bespoke mandates. So I think to that extent, that's the summary from me, and I'll now hand back over, James.
Tony, that was really helpful at setting the scene. Thank you so much. And I'm going to be turning now to Caroline. And please, Caroline, can you tell us more about the current rate environment and outlook, especially with regards to the negative yields, which Tony referred to? And I've put your first slide on here.
Thanks, James. So I'm going to recap over what we've seen over the last 6 months and talk through our forecast for negative interest rates, which I think everyone's interested to hear. So as a result of the pandemic, we saw nominal interest rates plummet. In the UK, central bank rates dropped from 75 basis points to 10 basis points. And in the US, rates dropped from an even higher point to near zero as well. In the Eurozone, as we know, rates are already deeply negative, and there's little appetite from the ECB to go lower, and instead they opted for measures to increase liquidity to the market through their current and also new purchase programs. Now, despite this, yields in the front end initially remained elevated. For some issuers, their funding costs actually increased as liquidity froze, and money market funds stopped buying short paper. Credit funds sold shorter positions in favour of more expensive, longer positions to meet redemptions on their funds. Now, some of the new programs from the central banks included facilities to support the short-term markets, the commercial paper markets, the repo markets, and from the Fed, we even had a facility to support money market funds. Now, as this liquidity increased in the system and corporates built cash buffers, yields plummeted very quickly, and they made new lows in euros and dollars. So, what is the prospect of rates going even further south and turning negative? And where is this effective lower bound for interest rates that we often hear referred to by central banks and economists? So the Fed has been quite vocal with their reluctance to take this path. They've instead preferred yield curve control in a similar fashion to what we've seen in Japan. For those that don't know, yield curve control involves buying certain maturities along the yield curve to bring down yields. And in actual fact, it's been a rather self-fulfilling policy, as it's something the Fed hasn't actually had to implement thus far, as often in these kind of policies, stating their intention to do so is enough to bring the market naturally in line to their target yields. In the UK, however, we've seen the rhetoric from the MPC members increasingly dovish. The new governor himself has changed his language and view on negative interest rates, stating earlier in the year that he doesn't believe negative interest rates are an effective tool, to recently, a couple of weeks ago, stating that it is one of the tools that they may use in their toolbox. And this hasn't only been from the governor himself, Andrew Bailey, but also other members of the MPC who seem to have also changed their stance. So the market has started to price in negative yields. Their belief alone that QE alone will not be enough monetary stimulus to increase consumer spending and demand and business investment. And some issuers in the sterling money market space have even been pricing in negative yields over the last month, which is something we've never seen before. Now, if you have a look at the slide on the screen now, this shows you the amount of negative yielding debt globally. There's been a significant increase in the amount of negative the yielding debt over the last 6 months. What is really interesting in these numbers on the screen is to notice that we've had 2 new entrants, and that's in sterling and in dollars. And these amounts aren't insignificant, and we do expect them to grow as well. And just for your information, and not to be alarmist, but one research house or one bank is pricing in a forecast that rates in the UK will move to minus 40 basis points in 2021. Although this is, I should note, particularly bearish and pessimistic view. So what are our views at Aviva Investors? Our view is that additional QE will come first, very likely in November and then perhaps again in February. The macroeconomic environment in relation to COVID continues for a long time. It's unlikely that QE will be enough. The impact of the pandemic is severe. We don't know how long it will continue for. And what we don't know at the moment is how many local lockdowns we will have or what proportion of activity will be reduced and for how long. Vaccines are a game changer and one that can create the much needed light at the end of a potentially short tunnel. But it's important to note that the support for the economy must not only be monetary, but it must also be fiscal, and support packages from the government are vitally important. At the end of October, the current furlough scheme is due to end. The expectation is that there will be an extension of this, perhaps something that's sector-specific, which means that the impact of COVID on unemployment might not be seen for quite some time. If the bank that's the MPC does move to cut rates further, then it's unlikely they'll cut 10 basis points. The move will need to be significant, and it's also likely to be implemented with tiering of bank deposits, something that the ECB implemented last year. Now, tiering is a policy where a higher rate or potentially 0% rate is applied to balances of a certain size, and then a more punitive fee for large deposits to encourage banks to lend, but also to lessen the impact on a strained bank profitability, which we all know is one of the reasons for the reluctance of taking rates negative. So there are a few unknowns, unfortunately. What we do know, however, is that rates will be at the most near to zero or lower for the US and the UK for many years to come. The recovery from the pandemic will take a long time, and the threat of inflation is such a long way off, with governments actually trying to fight off deflation. So what does this mean for money market funds? Money market funds should prepare for negative rates, whether they expect them to materialise or not, both operationally and from an investment management perspective as well. LVNAV funds should have in place plans to move to accumulating share classes or a VNAV structure, and in terms of management of the portfolios, perhaps a long duration strategy would be most beneficial. So what we've seen actually in sterling space is that funds have been increasing their duration over the last few weeks in particular, but also over the last 3 months or so. Those that made this play early on have benefited quite well because rates have been drifting lower for a few months. But because liquidity requirements are also required to remain high, you tend to see more of a barbelling strategy going forward on portfolios to achieve this strategy. Now I'm going to pass you over to James for our second polling question.
Okay, thank you, Caroline. So if I just bring up the next question for our poll. And so the question here is, which we're asking the audience, how would negative rates in the UK or US impact your allocation to money market funds? So this is specifically about allocation. So no material impact on your allocation, or please choose just one of the options shown. And Caroline, while we're waiting, one of the questions that's come in, and we're starting to see some questions, so please keep them coming, everyone, is from a client's perspective, how much higher interest do corporates earn by putting money into money market funds, i.e. after management fee, as against bank deposits? So we saw the earlier poll where we got slightly higher usage by value of bank deposits. Obviously, the current poll, which people are answering, goes to the heart of negative rates. Are you able to give some kind of generic answer, though, to that question? I realize it will vary by fund.
So, money market funds, their primary goal is for capital preservation. Liquidity and yield is more of a secondary consideration. You get diversification benefits with money market funds. In terms of the additional yield, to answer your question, I think that's going to depend wholly on what yields corporates are getting for their deposits. What we do know is that historically in Europe, which has experienced negative rates for quite some time, is that there's been a reluctance for banks to pass on those negative rates to corporates. But we have seen over the last few months this happening more and more. And in fact, there was a Challenger bank announced last week, I think it was, that they are going to be charging large retail balances as well at negative interest rates. So I think it's becoming more and more of a reality, whether in the past, if you've got a negatively yielding money market fund, you would get a higher yield by having a deposit with a bank. You don't get the diversification benefits, but that's changing, and there will definitely be a more competitive return going forward. And I think that it's likely, therefore, that if the US and the UK move to that, then we're already kind of quite well ahead, and people probably have an expectation that they would achieve a negative rate on the bank deposit.
And Caroline, there's one other relevant question, because it speaks to your slide, where it's sort of shown negative yields. But the question is whether that's translating into LV/NAV valuations. So the question is, what NAV movements have been experienced in the LV/NAV funds? Do investors experience lower NAVs, net asset values, against their original investment? So is that negativity passing its way through to the valuations?
If I understand the question right, it's in relation to the NAV deviations of money market funds and whether negative interest rates pass through to that valuation?
Yeah, I think in short, in simple terms, they're asking that you get back, at the moment, perhaps on a sterling LV/NAV fund, are you getting back less than you put in as a result? So is it yet flowing through?
So on a sterling money market funds, all of the sterling money market funds over the past few months, even during the crisis when yields were elevated, and yields have gone lower now, they've continued to price at 1. As we know, for LV/NAV structures, they have a collar of 20 basis points. Certainly no AAA money market fund breached that collar, even during the current crisis. So investors still continue to have their capital preservation, and for every unit that they invested in money market fund, they received a unit back. Yields and the interest that they receive or accrue on those funds have been drifting lower. Now, for prime money market funds, that's still a positive net return.
That's great. Caroline, thank you so much for clarifying those points. If we now move to the results of the poll, which follows on actually quite nicely from those comments you just made. Again, for people who are just dialed in by phone, the question was, how would negative rates in the UK, US impact allocation to money market funds? So we've got about 29% saying no material impact. We have 11% saying our systems are not able to deal with negative rates. 35% saying our allocation to money market funds would reduce in favor of bank deposits. 16% saying that their allocation to money market funds would reduce in favor of enhanced cash funds. And 19%, interestingly, would seek a bespoke mandate to meet our liquidity and return requirements. So Caroline, before we turn to Mohammed, would you like to react to that poll, please?
My initial thoughts that's interesting, particularly the allocation that are seeking out bespoke mandates. Mohammed's going to talk through that in the moment and the benefit of that, but it's certainly one of the stories that we've been trying to get across to clients to explore other options, because low yields on money market funds don't necessarily mean you have to take extortionate amounts of risk to try and offset that lower yield. So pleasing results from my perspective.
That's good to hear, Caroline. And indeed, it sets up Mohammed very, very nicely, because turning to Mohammed, you've seen the poll results. What options and opportunities do you see for treasurers to manage their liquidity in the current environment? Mohammed, are you still online? You might be on mute. Mohammed, I'm having difficulty hearing you at the moment, so if you can just check your mute button. So, Caroline, do you want to just briefly step in for a minute while we're waiting for Mohammed to get unmuted?
Have we got any other questions we'd like to go through while we're waiting for Mohammed, James?
Yeah, sure. That's a good idea. So one of the questions that came in is, under these circumstances, what information are clients asking you for? Are there specific queries coming in from corporate treasurers, and if so, what are they?
Caroline, shall I take that to a point? It's Tony. I think the considerations around how one would account for negative yields, and obviously that's come up in the poll there that 11% say their systems simply can't account for that. So clearly there's work that's going to be required around that. The other things of importance have been focused around transparency, the ability to get proper look through, the ability to get really quick information on the underlying assets that one is invested within. But not only with the individual fund they might be dealing with, but as a cross-reference across a number of funds in an aggregated look through counterparties, through exposures, etc. So that's the type of questions that we're getting at the moment from treasurers. You know, how do we account? And also, what's the dynamics of a move away from the current formats into, let's say, a new an accumulating share class? How will that in practice actually happen? Now, when obviously in answer to that, there's a notice period that will be given to all account holders for a migration away from the current format into a new accumulating share class. Clients would get the opportunity to either redeem their monies or just be migrated across, and that migration would be taken care of by our third-party administrator, in our case, JP Morgan. So they're the sorts of questions. How do we account for? How do we price? How do we capture? How do we get better transparency? And in reality, what would happen if we have to make that move to the new share class?
Yeah, I think if I can expand on that question of transparency bit, because it is a theme coming up in the questions. I think particularly treasurers are interested to understand perhaps better what are the underlying holdings within a fund, not just the overall credit rating, in part to understand their true diversification across funds. I know, talking myself to treasurers recently, there are some who thought they were diversified, maybe they were using 3 different funds, and actually found that the underlying holdings there was quite a considerable overlap. There are, as I understand it, and maybe you could just clarify, daily reports available, and that links to Solvency II and other requirements. But are those databases actually updated daily? So, Tony, I think it's probably another question for you, please.
Yeah, well, I can't speak for everyone, of course. I mean, everyone's systems react perhaps differently. But yes, I mean, ultimately, you know, if we have a request from a client to get access to daily information, then we would bespoke tailor that, and it would be sent Our portfolio holdings are weekly, as is pretty standard within the industry. And there always was a concern around the lag, because if you are aggregating across a few providers on your TMS system or indeed your execution venue, your aggregated portal, how can you be sure that that information is current? But I think we are finding now that the majority of are, yes, daily contributing that information so you can get a proper, real and up-to-date look through, yes.
And for the sort of perhaps medium-sized corporates, what sort of aggregation tools are there rather than spreadsheets for them to analyze their holdings across funds?
Well, I mean, there's a lot of third-party aggregators in our space. I've worked for most of them over the years, so there's a few out there. I'm sure that the audience pretty much know who they are without naming anyone specifically. But they are an execution venue. All of the fund companies are hosted on that technology, and within that technology, there are the reporting tools that treasurers are able to access as part of using those execution venues. So they'd achieve it through those means. Or if they've got a sophisticated TMS system, then they're able to achieve it through that.
Yeah, thanks, Tony. Another question, I mentioned credit ratings of funds, and I appreciate quite a lot of the questions are actually going wider than the immediate topic of the current rate environment, but it's clearly what's on treasurers' minds. So one of them is there an ongoing risk that money market funds will not be able to provide their own credit ratings? Is that something you've heard?
I can take that one if you like. It's not something that we've heard. I will probably point out that over the last few months, we've had continual dialogue with our rating agencies. I know some of them are dialed in to listen to this webinar. And it really is that constant and consistent communication and analysis of our money market funds and understanding our management technique and the steps that we're taking when we're operating in a stressed environment like the one that we have over the past few months is vital and it's important. We didn't see any funds lose their credit rating, and I think that is also very important and should provide clients with comfort. And also, from what we know by talking to clients, that AAA rating is important. And that's the reason why we solicit those ratings on our funds. And for some funds, they have more than one rating as well, which we do on many of our funds. I don't think that there's a risk of funds losing that AAA rating, given the fact that funds have been tested in what was a very, very stressed environment, and they did perform. So no, it's not something that I've heard, and it's not something that I think that's likely to happen unless there is some form of severe mismanagement by an asset manager. But because there's so much monitoring by and consistent dialogue with the rating agencies, but also really importantly with the regulators as well. So we've had a lot of calls with the regulators. I'm not sure at what point that would happen.
Thank you, Caroline. And I'm glad to say that Mohammed has been able to get reconnected with us. And Mohammed, I'm not sure if you saw the result of the earlier poll that we did. So just for your benefit, I'll put up the results and to remind everyone. And in particular, on this poll result, we asked about allocation in the event of negative rates. And the bottom category, 19%. Sorry, by bottom I mean bottom of the slide, not the lowest. We would seek a bespoke mandate to meet our liquidity and return requirements, 19%, which perhaps leads in nicely to some of your comments about how can treasurers optimize their yields. So, Mohammed, over to you, please.
Yes, thank you very much, James. Good afternoon, everyone. So, Caroline explained how monetary policy will be extremely loose in the next 2 to 3 years. Policy framework review by the Fed has changed its inflation mandate to an average inflation targeting. And this may be followed by other major central banks. So we could potentially see more tolerance for inflation globally. And what this means for policy is lower rates for even longer. And truly what this means is that we're entering a secular phenomenon that we're going to have to live with. And against this backdrop, it makes it more important for investors to be smart with their cash allocations. So for the next 2 to 3 minutes, I'll explain what being smart about cash means, and then I'll leave 4 minutes to talk about how we assess opportunities in the short end of the curve in the current market environment. So the idea behind being smart about cash is that rather than over-allocating to money market funds, investors should consider a tiered approach where they segment their cash into buckets. So for working capital needs, liquidity funds are probably the most suitable investment vehicle, offering security and diversification as well as yield. And cash here is typically used for daily or weekly operations. But for cash that isn't needed for 3 months and beyond, it doesn't necessarily need to be invested in a same-day money market fund. Clients can here choose to optimize it by putting it into a liquidity plus fund or mandate. In this core cash bucket, investors move slightly up the risk-reward spectrum while still maintaining an attractive liquidity profile. As an example, in the sterling space, for example, liquidity plus mandates can offer an additional 20 to 25 basis points return above money markets, and this can be achieved by investing in a AAA rated cash plus fund. So essentially, preservation of capital and liquidity that are the foundation of money market funds. But by investing very slightly longer, you get to take advantage of the credits and term premium embedded in longer dated securities. So how to go about this and how can investors achieve this? Investors can discuss with their solutions or fund providers to craft the right liquidity strategy by optimizing allocation to liquidity and liquidity plus solutions. And this will help maximize the overall risk-adjusted return profile of their portfolio. So one of the solutions could be a mix of money market fund for daily liquidity use and some to liquidity plus style fund with a 3 to 6 month investment horizon. And this allocation could vary depending on the client's requirements for immediate cash. But for for larger multinationals, a bespoke mandate, to answer your question, James, might be the best option. Here you can segment the portfolio into a sleeve providing liquidity and a sleeve that acts as a return or as a yield engine. They're ideal for clients that require a tailored approach in terms of risk and return, but also in terms of investment restrictions and ESG criteria, for example. A very important point here is that segregated mandates offer the same amount of transparency as money markets in terms of the underlying holdings and what's really in that fund. Another aspect of mandate is to leverage on the wider credit capability of the investment manager and have, for example, a co-management model with the credit team aligning two skill sets. And generally, while discussing with clients, some of the guidelines that we come across are clients' preference for an allocation to fixed bonds or floating rate notes, ABS, or, for example, non-base currency assets that we can hedge back to the currency of the mandates, allowing for international diversification and allowing for to benefit from international dislocations and opportunities. So, to assess the expected return as we move up the risk-return spectrum, we put together this chart that gives an order of magnitude on the general levels of credits, duration, and liquidity premium that we can harvest to achieve a surplus yield above money markets. We usually get the questions from clients investing in euros about if we can achieve a zero rate of return. Our answer is this is possible, but it would require to take a significantly higher credit and liquidity risk. And for us, it's absolutely important to understand the sources of return, what's achievable, and the risk and volatility that clients are facing when they invest in a particular asset class or duration. So there are three main sources of surplus yield. The first one is the term premium or duration premium. which is simply the compensation that investors require for holding a long-term bond, essentially is the price for commitment. So risk-free assets, such as the German or the UK sovereign curves, are inverted up to 6 years. So investors are in a situation where they'll accept lower returns for lending over a longer period than a shorter one. And it means that the market is expecting lower economic growth and lower interest rate environments. So we can generally assume that term premium is not necessarily a great carry or a great yield play in today's environment. Then we have credit premium, which is the difference between a corporate bond, for example, and a risk-free bond. And here we can find opportunities for a modest increase in weighted average life of the fund. High-quality bonds and floating rate notes can offer a premium relative to money markets. So in euros, for example, a 1-year floating rate note typically offer 15 basis points above money markets instruments. And in sterling, a AAA rated prime asset-backed security with a 2-year maturity offers around 40 basis points above SONIA, and it's above 70 basis points above SONIA when it comes to buy-to-let AAA rated ABS, for example, in the UK. The third source of premium is the liquidity premium, which means that illiquid investments need to offer higher yields than liquid ones. So typically a 1-year senior bond can be less liquid than a 1-year equivalent CD, and therefore it will offer a liquidity premium. So money market funds have already a high level of daily and weekly liquidity buffers, as well as they invest in highly secured and liquid securities. So when a daily liquidity fund is not required, segregated mandates can offer that liquidity premium. So I would just add on seg mandates that it's a very important point that cash plus strategies or segregated mandates will have around a third to a half of the fund invested in money markets instruments. And this helps to protect the portfolio if markets become illiquid or volatile. And it also allows flexibility to take advantage of opportunities in the markets, like when we had elevated levels of spreads during COVID crisis. So in summary, mandates can help collecting the structural premiums and at the same time focusing on downside protection and more importantly, liquidity management. So despite the zero rate environments that we're seeing at this point in time, clients should be focused on opportunities which are diverse enough, high in quality, and can actively adapt to the changing landscape to help produce that surplus yield above money markets.
I mean, that's great. Thank you. And I'm delighted we managed to get you reconnected. So thank you for that and for explaining all of that. We are very tight on timing now against the advertised end. And I still have a number of questions. I've been trying to feed them in. And the Aviva team, I know, has kindly agreed to provide answers that we can post onto the ACT website after the talk. It'll probably be next week for any questions that we don't have time to answer now. And what I would like to do, though, is we've had such a wide range of delegates registered for today's webinar, from treasurers of small charities and SMEs through to the largest multinationals and indeed financial institutions and banks. So for anyone who has to drop off the call shortly, can I just first ask Tony to imagine that I'm the treasurer of a mid-sized corporate who has to go and brief my board on the current environment for money market funds. Tony, can you just help me by summarising what are Aviva's key messages from today's webinar and the key takeaways, please?
Yeah, sure. I mean, I'll try and summarise the summary given in interest of time. But I think, we put forward the views on money market funds. Are they still fit for purpose? Are they in a negative rate environment? We believe that they are. And I think for many, and as the poll suggests, okay, only 29%, no impact. Ultimately, the practices and strategies ought not change too greatly. I mean, diversification is still key. Access to liquidity is still key, security of capital, and performance above the benchmark, it remains to be as important. So, you know, for a lot of people, the day-to-day business of managing cash won't change. But I think one thing is for sure, that the environment we're now in is going to encourage people to look for other options, perhaps to make some of their cash work a little harder and try and combat the impacts of negative yield. And I think to achieve that, it's imperative that treasurers really ensure that their cash pooling programs are up to task, that they have the visibility on their investments and positions, they have that transparency and access to information, and tailored reports in a timely manner and with accuracy. So risk management and access to information is really key. So I think that we've proven the last 6 months that money market funds are resilient, they're diverse, they do what they said they would do when they were set up. So we do have that viable vehicle for day-to-day requirements, but the low yielding environment is set to be with us for the medium to long term. So it's more prudent that treasurers look at the options that are out there, be smart with components of their cash allocations, the options of bespoke mandates outlined by Mohamed, you know, advancements in technology, partnering with companies that can offer depth of product. That allows for this, using sophisticated cash forecasting to segment their cash into buckets, be it immediate, to 3 months, 3 to 6 months or more. So cash that isn't needed for 3 months and perhaps beyond doesn't need to be invested in the same day money market fund with a stable NAV. It could be invested in slightly longer, in longer dated money market securities or in enhanced funds. So I think, you know, for small to medium sized clients, having an allocation to a Liquidity Plus style fund with a 6-month investment horizon, the allocation, of course, would depend on the client's requirements for immediate cash, but perhaps a 25% allocation would be appropriate. You know, and if cash is particularly sticky, then an allocation to a fund with a 12-month horizon may also be beneficial. So for large multinationals, a bespoke mandate may be the best way to achieve all of your liquidity requirements and your return requirements in one fund. We've been tailored bespoke mandates, seg mandates for clients for many, many years. And I think that the portfolios that are created, they do serve to give the liquidity needs and give the return requirements that the clients do desire. You could go a little bit further and allocate a portion into longer term credit, into longer term government securities, and in other asset types, and really take advantage of an investment manager's capabilities. But I think overall, it's important to know that any of the strategies that we've highlighted and talked through, they needn't impede on the credit quality of the portfolio. The strategy of blending an approach to cash investing is just about being smart with your cash. It's optimizing it for the best returns.
Tony, that's great. Very helpful summary. And we have reached the end of our time. It's clearly a big topic, and we hope you found this session informative. Thank you again to those of you who contributed questions. We've tried to cover as much ground as possible, and I apologize if we didn't get to your particular question, but as I said, the Aviva team has kindly agreed to look at those, and we'll post some answers over the next week or so. So do keep looking at the ACT website, that's treasurers.org. And please, a request, can you fill in the quick survey immediately after this session, as the feedback you provide is very helpful to us when arranging future events, so we would appreciate your thoughts. And talking of future events, I'm personally excited about the ACT's annual conference from 5th to 8th of October, which promises to take the concept of a virtual conference to a whole new level of interaction. So do make sure you've registered via the ACT website. But finally, on behalf of the audience, I'd like to thank Aviva Investors and our excellent panel of speakers today. That's Tony Colcott, Caroline Hedges, and Mohamed Balfaida. This has been James Winterton for the ACT. Thank you and goodbye.
Thank you.